Hi, I'm Will from Unleashed, and in this video I'm going to explain the various costing methods for inventory. So we have the weighted average method, we have the Lifo method, and the Fifo method. Now Lifo stands for last in, first out, and Fifo stands for first in, first out. Now the easiest way to explain the difference between these three methods is to give you an example. So I want you to imagine for a moment I have a shelf here with 10 cans on it. Let's say they're 10 cans of peaches. Now let's say the first 5 cans of peaches I purchase at $1 per can. Now the next 5 cans of peaches I purchased at $2 per can. So the price doubled with my next order. So my first order cost me $5, the next order cost me $10. Now, if you were to come to me and say, hey Will, can I buy a can of peaches from you? I'd say absolutely, but the question now becomes, what does it cost me to sell you a can of peaches? See, under the Lifo method, it's the last in, first out that we calculate our cost on. So the last in cost me $2, so it cost me $2 to sell you a can of peaches. So I therefore calculate my profit based on a $2 cost. Under the Fifo method, however, it's the first in, first out. So the first can that went in cost me $1, so it cost me $1 to sell you a can of peaches, and I calculate my profit based on a $1 cost. Now, under the weighted average method, what we're doing is we're taking the total cost, which would be $15, and dividing it by the 10 cans, which gives me $1.50 per can. So under a weighted average method, it would cost me $1.50 to sell you a can of peaches, and I calculate my profit based on a $1.50 cost. So those are the three methods, but the question is now, which method do we choose? Now, the first thing to point out here is Lifo is not accepted under the General Accepted Accounting Practices, or IFRS, the International Financial Reporting Standards. So straight away, we can ignore Lifo because it is not accepted internationally. So that gives us two methods to choose from, being the weighted average and Fifo. Now, Unleashed uses the weighted average, and there's a lot of benefits of using the weighted average over Lifo. The key thing here is under Fifo. So under the weighted average, the big benefit is it's a lot easier from an administration perspective. When you bring stock in and then you sell stock, you don't have to worry about which unit is coming in and out. Where under a Fifo basis, we'd need to be tracking which stock we're selling based on the batch that it was ordered. So it does come with a lot more administration. The other benefit of using the weighted average method is we're going to get a lot smoother reporting when we're tracking our margins. So when we're looking at a margin report for a product over, say, 12 months, if we're using a Fifo method, we're going to see some really sharp spikes based on the cost of each order, but under the weighted average, those lines are going to be a lot smoother so we can make better decisions with the information. So that's the difference between the three methods. We have weighted average, we have Lifo, and we have Fifo. We can ignore Lifo because it's not accepted internationally, which just gives us Fifo and weighted average. Unleashed uses weighted average because of the reasons we have discussed, one being the administration is less, and finally it makes our reporting a lot easier because we get smoother information. Hope that is useful, and I will see you in the next video.